Good afternoon, everybody. My name is Mahmoud Bagheri, and I am teaching at IALS on financial law, and then I used to be a course director for the LLM on financial law, and then I also have been publishing in the area of financial law and regulation for many years, although I've been also practicing in recent years, but I'm very much into the academic areas, and then have an interest in the topic that we are going to have today. Anyway, I would like to welcome Professor Alexandros Sertakis from University of Dublin, Trinity College. Professor Sertakis has extensively published in the area of the law and financial regulation, particularly the relationship between financial law and technology. And then he did his PhD in University of Luxembourg, where he also taught, and then moved to the University of Dublin. He's also a research fellow at IALS, where we treasure his presence, and we are very happy to have him today. I eagerly, really looking forward to learn from this decentralized finance, to see what is happening to the decentralization in finance, and then how centralization is disappearing, and then what are the legal implications. So without any further ado, I would like to invite Professor Alexandros Sertakis to present his talk today, and then there will be opportunity for everybody to participate in discussion and ask questions. Alexandros, the floor is yours.
Yeah, so Mahmoud, thank you a lot for your for the introduction. Of course, thank you for having me at the institute. I'm not physically there now, of course, because of COVID, because I had to stay in Dublin to teach face to face. But I had the chance, to visit London, before Christmas, and actually it's very funny because I also completed a master's at UCL, right next to you. So as a student, I used to come and study at the institute. So I know the institute pretty well for many years. So so thank you very much for the invitation. So my talk today, I'm basically active in the field, in two fields, I'm active in investment funds, I'm researching on investment funds. And the second area of my research is fintech, digital finance, and all the innovation that's going on in financial markets. So the previous years, the talk of the town was Bitcoin, terms like fintech, and etc. Whereas today I want to talk about something different, and something which is the talk of the town today. So I'm going to talk about decentralized finance, and I'm going to give an introduction, an overview about what that is, and then I'm going to explain the opportunity that decentralized finance can offer, the opportunities that it can offer for the financial system, the risks, and then certain thoughts regarding the regulatory response to this phenomenon. So, so decentralized finance is a subset of fintech. So it's an evolution of fintech. So, and what is fintech? That was, you all have heard of the term. So the Bank of International Settlements has defined fintech as technologically enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services. So decentralized finance is exactly this. It's basically innovation that relies on new technological developments in order to offer financial services in a more efficient way. So now, in general, the areas where we have seen innovations during the last years, I mean, fintech really took off right after 2014, 2015. And the areas where we have seen a lot of innovations include retail banking, right, with the advent of digital banks, infrastructure, payments, capital markets infrastructure, investment advice, and asset management. Asset management, for instance, you can think of robo-advisors, which are becoming very popular. The technology used in this fintech wave include artificial intelligence, machine learning, big data, smart contracts, and blockchain technology. And I'm going to discuss how decentralized finance uses some of these technologies. Now, of course, fintech, in terms of innovation, technological innovation in financial services, always existed. If you can think of the ATM, that was truly an innovation. So it can be considered a form of fintech. However, what's different today with this fintech wave is the fact that a lot of these is the explosion in technology, right? The explosion in artificial intelligence, the explosion in machine learning, big data. So that opens, right, vast opportunities for offering financial services in a different way, right? And some of these innovations that right we've seen in the last year include digital banking, the offering of digital insurance, of course, cryptocurrencies such as Bitcoin, robo-advisors, alternative credit scoring, firms that are being set up, crowdfunding, and peer-to-peer lending. So these are some of the new technologies that are being implemented in the financial system. And if you can see today, there are two current developments. There are two opposing models of financial service infrastructure integration. So we've written that with a colleague, Emilio Safuleas. So, right, and what we say basically is that the transformation of the marketplace and of the finance value chain is manifested today through two radically opposing models of financial services infrastructure integration. So, on the one hand, the first model is represented by the increasing domination of the financial services infrastructure by very large institutions like the American investment giant BlackRock that operates the infrastructure service Aladdin, and the Chinese powerhouse Ant Financial. So we see these very large companies dominating. At the same time, there's talk that's certainly going to happen in the future of big tech companies such as Google, Facebook, entering the wholesale and retail financial services. So you remember all what happened with Facebook, which basically tried to launch its own currency, Libra. So we're going to see that even more in the future. These big firms can leverage their data, the data and information about users to offer financial services to their users. So we see on the one hand a model which is a very centralized model, right? The domination of certain firms. And on the opposite side, at the same time, we see an opposing model, a model of decentralization, which is basically the emergence of decentralized finance, which for now is mostly operating in the alternative finance space. So what is decentralized finance? So decentralized finance is a part of the so-called alternative crypto financial system. So, and this can be traced back to the creation of Bitcoin. So even though a lot of people criticized Bitcoin, even though a lot of people thought that it was a scam, other people thought it was a revolution. What everybody agreed on was the potential of Bitcoin's underlying technology, namely the blockchain, which I'm gonna discuss a bit later give an introduction about blockchain and its benefits. So Bitcoin was the first of its kind. So a number of other currencies came into existence, such as Cardano, XBR, Dogecoin, which it started as a joke, and it has now become one of the biggest by market capitalization. And then you had another major turning point in the journey towards decentralized finance was the creation of Ethereum, of the blockchain, which basically supports smart contracts. And that was the real catalyst for the emergence of the decentralized finance. As I'm going to explain later on, most of these, decentralized finance and all these decentralized applications are basically, rely basically on the Ethereum blockchain. So, and rely on smart contracts. And the blockchain technology, in general, gave rise to the creation of a number of other crypto assets, such as stablecoins and tokens. So now, that was by way of an introduction how things evolved and how we arrived at the current explosion of decentralized finance. Now, what exactly is decentralized finance? What are we talking about? So decentralized finance basically refers to an ecosystem of financial applications which are run by smart contracts that are built on top of blockchain networks, usually the Ethereum blockchain. So we're talking about an ecosystem of financial applications that is built on top on the Ethereum blockchain. Usually on any blockchain network, but it's usually the Ethereum blockchain. So researchers and other researchers, for instance, defines it more specifically as an open, permissionless, and highly interoperable protocol stack built on public smart contract platforms such as the Ethereum blockchain. So, and I'm going to discuss later on, what smart contracts are, how they operate, and what their benefits are, and some type of decentralized applications that exist. Now, in general, decentralized finance seeks to replicate existing financial services. So there's lending and borrowing, there's asset management over there, there's trading. So decentralized finance tries to replicate existing financial services and create a more open and transparent financial services ecosystem that operates without any central authority. So that's the whole point of decentralized finance, meaning the operation, the lack of any central authority. So, if you think of today's capital markets, today's capital markets operate only on the basis of the presence of numerous financial intermediaries, be it investment banks, stock exchanges, asset managers, banks, broker dealers, lots of intermediaries involved. And that's the main, as I'm going to discuss towards the end, that's the main promise of decentralized finance, is that you can offer these financial services such as borrowing and lending without having the intermediary, namely the bank. So decentralized finance builds on top upon a combination of two technologies. First one is smart contracts, and the second one is blockchain technology. So now let's discuss a bit about smart contracts. What are smart contracts? So smart contracts are basically contracts whose execution is automated by computers according to previously determined terms and conditions. So it's a software code that's basically stored on a blockchain-based platform that automatically executes an agreement. So smart contracts were first proposed as an idea in 1994, and the author basically offered the simple example of the vending machine as being a very primitive form of a smart contract. And a smart contract, like a vending machine, has logic programmed in it, namely if A and B happen, then C should follow. So in 2013, one of the co-founders of Ethereum, in a white paper, proposed basically the concept of Ethereum, namely a decentralized blockchain-based smart contract platform. So in Ethereum, on this platform, anyone can join this platform and anyone can write a smart contract. So you can create, provided that you have the technical knowledge, you can create your own smart contract. And smart contracts, according to many, are going to result in the replacement of regulation by smart contracting. So-called lex cryptographia. So that's going to be the new mode of regulation. Now, what are the benefits of smart contracts? The first benefit of smart contracts is that they're transparent. You know what's going to happen. There's the software code is basically the logic is basically transparent to everyone. And second of all, they offer a high level of security. So so in today's financial markets, there are human and there are institutions involved. So for instance, imagine a case where if A happens, then the bank should give you back your money. So there's a chance that even if A happens, the bank will refuse to give you your money. It won't happen automatically. There's certain process, certain human beings that will be involved over there. So in contrast with smart contracting, you have a high level of security. You know that if A happens, if the previously determined terms and conditions happen, then execution will be automatic. And of course, smart contracting can be used, and of course, that's why smart contracting is so important, because in the blockchain, in the Ethereum blockchain, decentralized finance platform, you know that, for instance, if you agree on a token transfer, you agree that you know that the smart contract will automatically execute the transfer. So, for instance, the smart contract will say that once you receive your compensation, then automatically the token transfer, your token transfer will be sent to somebody else. So that's the first new technology that we have, and which basically is one of the two technologies that are fundamental for decentralized finance. The second, of course, the very important technology is the blockchain, which basically the blockchain is basically an electronic ledger which allows users which do not necessarily trust each other to share the responsibility of database management without recourse to a central validation authority. So today we have different proprietary databases which are scattered along in different financial intermediaries. So there's no single database, there's no single authority over there which says, which gives an overview of all the transactions. They're different proprietary ledgers. So, and that's the benefit. And there's always somebody who decides, a central authority, who decide what is, which will decide what will be included in the ledger and what will not be included in the ledger. So there is this element of trust to a central validation authority. Now, blockchain is an electronic ledger which allows users who do not know or trust each other to share the responsibility of database management without recourse to a certain central validation authorities. Now, the blockchain basically records transactions in a sequential archive. All individual transactions are stored in blocks. That's why it's called the blockchain, which are attached to each other in chronological sequence using cryptographic techniques called hashing, creating thus a long chain. And this chain basically forms a record of transactions. So with a blockchain, everybody sees the same state of affairs, and everybody sees the same record of transactions. Now, the blockchain can be used and is starting to get used, or there's starting to be a lot of experiments. It can be used to transfer, store, and maintain ownership records of digital assets or digital representation of assets. And for the confirmation and addition of transactions to the ledger, the blockchain uses consensus algorithms. So, for instance, the Ethereum and Bitcoin use a proof of work consensus mechanism, which basically means that miners, these are the so-called people that use their time and computation power to process transactions and produce blocks. So, and these are the two technologies which are fundamental for Ethereum, all right? It's the blockchain and it's the smart contracting, which are fundamental for decentralized finance. So it's the blockchain and then it's smart contracting. And the innovation and why a lot of these, why decentralized finance is usually built on top of the Ethereum network is basically the fact that Ethereum is a blockchain platform. It was the first blockchain platform that also introduced smart contracts. So you can you can have the best of both worlds. So, and over here you can see, right, the explosion in decentralized finance, especially during the last years, and especially during the COVID crisis. So you see the total value locked in decentralized finance has skyrocketed. So, and over here, there's another chart regarding the venture capital-backed decentralized finance companies. All right, this is the amount that is currently invested by venture capitalists in decentralized finance companies. So it's considered to be, right, decentralized finance, the new thing, even though the amounts are still pretty small compared, right, to, for instance, Google or Facebook or any traditional investment banks. Still, still the amounts are increasing, and you see a lot of interest from venture capital funds in supporting this type of companies. So, as I mentioned to you, let's look closer at some kind of services that decentralized finance can offer. So decentralized finance, as I mentioned to you, replicates a variety of existing financial services. So the major services offered are stablecoins, decentralized exchanges, think of stock exchanges, right? They try to replicate stock exchanges, lending, derivatives, insurance, and asset management. So all these services are offered on decentralized finance platforms. So stablecoins are very crucial for the ecosystem, and stablecoins are basically crypto assets whose value is pegged to a reference asset, usually the US dollar. And I'm going to discuss more in detail what stablecoins are and why they're crucial for the decentralized finance. Furthermore, decentralized exchanges allow users to trade digital assets. Decentralized lending platforms allows users of decentralized finance applications to lend and borrow crypto assets. Decentralized derivatives are tokens deriving their value from an underlying asset. So they basically mimic derivatives in the traditional financial system. And on-chain funds, investment funds, allow users to invest in a basket of crypto assets. So with respect to stablecoins, right, why were stablecoins introduced in the decentralized, and why are they important in the decentralized finance ecosystem? So the point with the traditional cryptocurrencies such as Bitcoin is the fact that they exhibit very high price volatility. And that's why everyone agrees, most of the people tend to agree that these cryptocurrencies are not real currencies, because one of the requirements is that one of the requirements of a currency is that it is basically a store of value, that it shouldn't exhibit a very high amount of volatility. And and you can think of the US dollar and the euro. I mean, why are they considered to be why are they considered to be proper currencies? Because of the fact that basically you know that they don't exhibit very high price volatility. In contrast, if you see what's going on in Bitcoin, in HPR or Dogecoin, you can see that that they basically exhibit a very high degree of volatility. And basically, that's why stable coins were created. So stable coins were basically created to mitigate the effects of price volatility, functioning as a store of value and a unit of account. So stable coins are used in decentralized finance platforms because they exhibit less volatility and they facilitate better fund transfers between users in a particular decentralized finance platform and across platforms. So now, so stable coins are the way that transactions are done in the decentralized finance world. So, and secondly, they also serve as a bridge between the decentralized finance world and the financial system. And that's because most of these stable coins have as a reference asset the US dollar. So, and we have certain categories of stable coins. We have centralized stable coins, which are not considered to be decentralized finance instruments because they're centralized, which are basically backed by fiat currency, the US dollar, with the peg over there realized off-chain through regulated financial institutions, which serve as depositaries of the currency. So, and because you have the involvement of the traditional regulated centralized financial institutions, which are responsible for serving as depositaries and maintaining the peg. That's why you don't talk about decentralization here. You don't talk about decentralized finance, but you talk about, but that's why they're not part of decentralized finance. The category of stable coins that are part of decentralized finance are the ones that are backed by cryptocurrencies which serve as collateral. So over here, the stable coin will be backed by other cryptocurrencies, such as Bitcoin, for instance, which will serve as collateral. So these stable coins will basically use smart contracts to assemble and liquidate the collateral on chain, on the platform, in contrast to centralized stable coins. And finally, you have the case of algorithmic stable coins, which are not so the most widely used categories of stable coins are centralized and are the two first categories that I mentioned. Algorithmic stable coins basically seek to maintain the peg. As I mentioned to you, they seek to maintain a peg, usually with the US dollar. Say one stable coin would be $1 US. So they seek to maintain it. The peg by adjusting the supply of stable coins, by issuing or destroying coins in order to match their demand. So an example of a stable coin which is really widely used in the Ethereum network for fund transfers is basically DAI, which is a US dollar denominated asset-backed stable coin built on the Ethereum blockchain. So basically, and it's created by a decentralized autonomous organization, by the maker, decentralized autonomous organization. It uses Ether as its own chain collateral. Its stablecoin must be backed by at least 150% of Ether. And if the collateralization ratio falls below 150%, smart contracts will trigger the liquidation of collateral and redemption of stablecoins. So this is by way of giving you a real-world example of how stablecoins are operating in the decentralized finance space. So, and over here you can see some of these, the biggest stablecoins by market capitalization. So you can see that their market capitalization can reach 80 billion, USD coin close to 50 billion. So and the stablecoin that is used in the Ethereum network, right, it has basically reached, it's close to reaching a market capitalization. It's number 5, close to reaching a market capitalization of 10 billion. So this is with respect to stablecoins, right? And I mentioned their functionality in terms, in the setting of decentralized finance and or in the setting of a decentralized platform. Second type of services offered by decentralized finance platforms are basically decentralized exchanges. So these exchanges basically allow for the trading of crypto assets without the need of a trusted central authority. So centralized exchanges, require basically traders to trust an operator to safeguard user funds, provide accurate price information, match buyers and sellers to process trades, settle transactions, and engage in transaction monitoring. For instance, think of when you want to trade a stock in modern financial markets, think of the number of intermediaries involved over there. You have stock exchanges, you have the central CCPs, there are a lot of players involved over there. In contrast, in decentralized exchanges, you can trade without the need for any trusted central authority. So it's mostly a peer-to-peer world, right? A peer-to-peer exchange of crypto assets. So the transactions over here are automatically processed by smart contracts. Namely, if you transfer to me your stock, then this thing will will automatically happen. Or if you transfer Bitcoin or a stable coin to me, then automatically you will become the owner of the crypto asset that I hold. So, and they basically, and another major difference with today's the stock exchanges in modern day in the traditional financial system is the fact that they use the so-called automated market making system to process trades, right? And these are basically prices over there. Prices in decentralized exchanges are determined on the basis of mathematical formulas which are based on transaction volumes. So it's a very complex system, but it's a very different one. So you have basically prices determined only on the basis of mathematical formula, which are in turn based on transaction volumes. Now, in general, the infrastructure services that are offered by decentralized exchanges tend to be cheaper in terms of trading and listing fees than centralized exchanges. So third type of services offered by decentralized platform that is worth mentioning. It's basically the decentralized loan platforms. These loan platforms allow people to lend and borrow crypto assets. So, you can borrow. These are loans, and you can with these loans you can basically borrow crypto assets. So, the loans in decentralized loan platforms are basically permissionless. There's no central authority, right? There's no bank in the middle. Everyone has access to the platform. Everyone can potentially borrow money or provide liquidity or provide itself loans to earn interest. There's no need for credit checks or other borrower-specific evaluation, right? You know, if you go to a bank to obtain a loan, the loan is not permissionless. You can. There's a need for credit checks. There's a need for borrower-specific evaluation. There's some, and the bank is basically the central authority. It's basically the intermediary involved. In decentralized loan platforms, you don't have any of these. These platforms are totally permissionless. There's no need for credit checks, other type of evaluation. That's because what is important here is collateral. So loans in the main region. Of course, you're going to ask if there's no credit checks or other borrower-specific evaluation, how is the lender, how am I supposed as a lender to be protected? And the answer here is basically collateral. So decentralized loan platforms are based on collateral. So that's the most important, that's the thing that allows them to function. So these loans are basically backed by collateral in the form of other digital assets. So, and if the collateral value falls below a specified ratio of the loan value, which is usually around 150%, so there are over collateralization requirements. So, and if the collateral value falls below these requirements, the position is automatically liquidated to pay back the debt. So collateral is automatically liquidated in order to pay back the debt. So, and of course, you know that these things will happen. There's certainty, you have a level of security because all these things are done by smart contracts. They're executed automatically. So once the collateral value falls below a specified percentage, then smart contracts will be automatically triggered and they will be executed and the position will be automatically liquidated. And the major innovation that we see, even though that's still in the experimental phase, right? I'm just mentioning, right, because I find it very interesting. They're still not, it's still in the experimental phase, are the so-called flash loans, which are basically loans that are repaid atomically. So in this type of flash loans, the borrower receives all within the same blockchain transaction. The borrower receives the funds, uses them, and repays them. So that all happens within the same blockchain transaction. And if something of these, if one of these three steps, right, if the last step doesn't happen, if the borrower, for instance, doesn't repay the debt, then this blockchain transaction will not be complete. It will consider as the blockchain transaction will not have happened at all. So the blockchain transaction will only happen if all of these three things happen. The borrower receives the funds, uses them, and repays them all within the same blockchain transaction. So now, after having discussed, I'm giving you the general overview of some of the important services offered by decentralized finance platforms. And what are the opportunities here? So the opportunities, one of the main advantages of these platforms is basically that they exhibit a high level of interoperability and accessibility. So Ethereum's composable software stack basically ensures that decentralized finance protocols and applications are built to integrate and complement each other. So you have stablecoins that are built which basically complement other applications, such as because they're used to transfer funds. So in decentralized exchanges, it's stablecoins that are going to be used for as a type of for the exchange. So so you have a lot of applications that are complementing one another. So developers and product teams, and that's one of the benefits of decentralized finance platforms, can build on top of existing protocols, customize interfaces, and integrate third-party applications. These protocols are often compared with Lego pieces. So you can build anything you would like inside there. You can basically build on top of others' ideas. You can build a new app on top of other applications. So, and that's called also open financial engineering. So any application that has been created can be used to create something entirely new. The second advantage is the fact that these platforms, these decentralized finance platforms, are basically open to everyone. So they're basically accessible to everyone, contributing thus to an open financial system. So, right, if you think of the traditional financial system, it's not really open to everyone. One of the biggest problems is the lack of access to financial services, which are offered by the traditional financial system, and that's also. And regulators and politicians agree that one of the benefits of fintech is the fact that of all these technologies is that they can widen the access of certain groups to the traditional financial system. And of course, because over there you have an issue with identities. There's not everybody must disclose their identity. The risk of discrimination is pretty higher. So in the case of loans, right? In the case of loan, there has to be, you have to reveal your identity. There have to be checks, borrower-specific evaluation. So over there, that of course, when when you reveal your identity, the risk of discrimination is higher. In contrast, decentralized finance, right? It's open to anyone. Anyone can join, or anyone can build applications. And second, there's a lack of identities. So, right, you don't disclose your identity when you enter into a decentralized finance platform. Therefore, right, in terms, for instance, one example in the case of decentralized loan platforms, as I mentioned to you, in order to take a loan, you really don't need to disclose anything. There's no central authority. There's no credit checks that are done. So this thing basically lowers the risk of discrimination, and that's considered to be one of the advantages of decentralized finance. Second, another advantage is efficiency. So decentralized finance platforms can provide financial services more efficiently than the traditional financial system. So the traditional financial system relies on centralized institutions. There are numerous intermediaries involved. You all know this in centralized, in traditional markets, stock exchanges, brokers, custodians, CCPs. And the inefficiencies include costly and slow transfer of funds, brokerage fees, lack of securities, fees, the delay in settling transactions, so-called T+2 and T+3. However, all these things, these problems don't exist in decentralized finance platforms. As I mentioned to you, fees can be lower. Look at the example of decentralized exchanges. Then there's the elimination of numerous intermediaries. You don't have intermediaries such as brokers, stock exchanges. Even there's the elimination of the long custodial chains, since market participants always keep custody of their assets and control of their personal data. So you have control of your assets and personal data in the decentralized finance platform. And this, of course, elimination of these intermediaries brings lower costs. There's no fees involved and faster transactions. And finally, you have the benefit that smart contracts reduce execution risk that exists in financial markets. Another benefit of a decentralized finance platform is also the transparency that they bring. All transactions in a blockchain are basically publicly observable. Everybody can see the transactions on the blockchain. Everybody sees the same transactions. And this level of transparency around transaction data allows for uninhibited data analysis, making orders and transactions highly auditable. This publicly available financial data may be used by researchers and users. Contrast the traditional system where data are contained in different proprietary databases or not available at all. And in the end, right? Especially the availability of historical data may make spotting bubble and predicting crisis easier. So these were in general the benefits that the opportunities brought by decentralized finance. Of course, then decentralized finance has its own risks. One risk, of course, is that one of the downsides is that permissionless platforms where anyone can join do not police and monitor identities and individual accounts. Therefore, they may be used by the underworld to transfer, invest, or launder money that are either the proceeds of crime or tax evasion, or can be used to finance terrorism. In contrast, mainstream financial institutions are implementing know your customers and anti-money laundering procedures. However, what these decentralized platforms claim is that they operate effective, even though they don't operate know your customer procedures, they operate effective systems to police the integrity of the market by monitoring activity. So they claim that they moved from a know your customer to a know your transaction model. So second risk of decentralized finance is that even though proponents claim that decentralized finance is decentralized and there's no central authority, we can see that there are these platforms are only partially, a lot of these platforms are only partially decentralized. And why is this? It's because these networks, these decentralized networks, allocate governance rights by issuing governance tokens. So the holders of these tokens basically vote on proposals, having the power to decide the modification of the code. And these governance tokens are usually allocated to platform developers. So some of these platform developers may end up having a large share of governance tokens when creating the network. So therefore, we see elements of centralization even in so-called decentralized platforms. Then another problem is that a lot of these decentralized lending and trading platforms allow for the creation of a high amount of leverage. We all know the downsides of leverage. And that's why, and why is that? It's because, first of all, the collateral that is used in the system can be reused to serve as collateral in other transactions. There's a high amount of leverage and lower margin requirements that are permitted, for instance, in decentralized exchanges than in regulated ones. So they have a lower margin requirements, allowing participants to obtain higher amounts of leverage. And then an additional problem is that decentralized finance relies solely on collateral to mitigate risk. There's no public backstop right to protect the system in case of failure. There are no lender of last resort facilities. For instance, there's no central bank, no lender of last resort facilities. Finally, there's the issue of certain technical vulnerabilities, and there's been a recent studies on this point. So, for instance, the authors of these studies document and quantify the widespread and rising deployment of arbitrage bots in decentralized exchanges, which basically exploit inefficiencies in these exchanges, paying high transaction fees and optimizing network latency to front run, mainly to anticipate and exploit ordinary users' trades. So there are a lot of issues of vulnerabilities in decentralized finance platforms, and people have started to exploit these vulnerabilities. And the problem is that because you don't have anybody, you don't have a central authority. That's why there's nobody really there. In many cases, there's nobody really there to fix these problems. So, for instance, these, if you see what happened with these researchers, is basically they published this strategy, which the arbitrage bots were using to exploit ordinary users of decentralized exchanges, and then even more bots started exploiting this strategy before the community closed the loophole. So, and finally, another major category of risks are the risks associated with smart contracts. So smart contracts, once deployed, are very difficult to upgrade, and numerous technical vulnerabilities such as coding errors may be exploited by attackers. There's been a lot of attacks taking advantage of problems in coding errors in smart contracts. And another major point is that smart contracts, as I mentioned to you, and applications interact with each other, allowing the creation of new services based on a combination of existing ones. Therefore, if there's a problem in one smart contract, that will have an impact on other smart contracts and applications in the decentralized finance ecosystem. And finally, also a point with respect to decentralized, with respect to smart contracts, that you have the so-called Oracle attacks. So many smart contracts are reliant on external data. Oracles are the service providers that provide outside information to a smart contract. So, and oracles are basically crucial for triggering liquidation, deleveraging, margin calls, and other forms of automated collateral management. However, there's a case where these oracles might be attacked, which involves basically manipulating the oracle, such as manipulating the market price of collateral referenced by a decentralized finance protocol in order to trigger liquidations. Now, and finally, before I close today's talk, right, I'm going to offer some thoughts about the current regulatory environment. Now, in general, the major financial law regulatory pieces existing today were adopted before the rise of digital finance and do not account for the problems posed by these new technological developments. So regulation basically has to become more proactive in order to foster regulatory experimentation. So for instance, if you can see one example which shows you that today's regulatory environment is not fit for the rise of decentralized finance, is the fact that all these platforms that I mentioned to you provide direct access to retail investors willing to trade in the platform. However, today's trading venue don't offer direct access to investors. So instead, investors obtain access via financial intermediaries. Therefore, right, and according to regulation, trading venues, any trading venue can accept as members or participants only investment firms, credit institutions, and other institutions which possess an adequate level of trading ability and sufficient organizational standards and resources. Another example of the difficulty of understanding how the current regulatory environment will apply to decentralized finance is, all right, you have in modern financial markets, you have the so-called all these conduct of business duties that firms and operators must abide by. But in a decentralized finance, which is going to be the authority that's going to be responsible for discharging all these COB conduct of business duties. Nevertheless, we can see we can see that regulators have understood these problems, that we can see that regulators have started to become very serious about the potential of digital finance in general, and about the fact that they should alter the regulatory regime in order to provide a boost to these innovations. So, for instance, you can see the recent initiatives such as the digital finance packets across in the EU, where you have more a regulation about stablecoins. Then you have a pilot regime about distributed ledger blockchain platforms. So we see movement on the part of regulators, which are trying on the one hand to understand technology and on the other hand, to also understand how the current legal regime impedes the development of these innovations. So I think I'm over with my lecture. So thank you very much for listening to me. And I look forward to any questions or thoughts that you might have.
Okay, I mean, thank you so much. I really enjoyed it throughout your lecture. It was very informative, very useful. You know, still raises questions about the interface of this virtual world with the real world. And then, of course, there are some other issues. We have one, I think, question from Professor on the question and answer. Professor Dimitris Ziavos asked a question.
Yeah, I see the question.
Okay, can you answer and read the question for the others and then answer it, please?
Could you, the question is, could you elaborate the use of know your transaction model instead of KYC? Is there still full anonymity? Yeah, they're full. It's still, there's not you don't reveal identities. Although we don't say that it's fully anonymous, it's pseudonymous, we say, because there are certain ways that you can find identities, but very complex, very technical. So it's very difficult to find the identity of participants. And what is, what they claim, it's still to be seen. And I don't think that, I don't think that this know your transaction model is basically makes any sense, or that they are abiding by it. Is that they claim that they can see any suspicious activity instead of know your customer procedures and etc. They think that they could monitor any suspicious activity via monitoring the transactions on the blockchain. So that's what they say. They say instead of asking each individual user, know your customer and where did you get that money, and are they the proceeds of terrorist financing or etc. We don't do that, but we can understand all these things via monitoring the transactions on the blockchain. But it's still to be seen how this is done. I'm a bit skeptical on whether, and everybody in general is a bit skeptical about what that actually means.
Okay, while we are waiting for others to ask questions on the chat or question and answer part, I'm very curious. Honestly, this is so great that this decentralization saves so much transaction cost of intermediation. But on the other hand, there is one big question of the interface. Because at some point, anyway, you need to move from the virtual world to the real world. And that is where you need to come some kind of recognition and from the governments, the states. And when the recognition comes, then they will regulate it. So how you can reconcile that one, and how this, how can I say, border or the gate for interaction between these two paradigms could be, sorted out, and then while not damaging what is achieved through this decentralization.
Exactly, and that's the danger, right? That you're gonna exactly as you say, right? When decentralized finance is gonna become bigger. Now it's pretty small. There are no repercussions for any failure in decentralized finance platforms. Won't really have any repercussions in the global financial markets, right? The amount of trading that is done on these exchanges isn't the amount of trading that is done on the New York Stock Exchange or on the London Stock Exchange. So that's why regulators are still adopting a pretty differential approach. But the question is that what happens when, and all these discussions, not only for that, it's also a discussion about Bitcoin, as we've seen, and etc., is what happens when these things will become big enough, right? Are the regulators gonna allow it? I mean, there's even a question whether other regulators will allow a lot of these services. So if you saw recently what happened with Libra and Facebook, where they tried to launch a stablecoin, and of course they didn't say anything, but the regulators were negative towards that. And I guess one of the main reasons why they decided to abandon it altogether was basically the pressure from the regulators. So it's still not certain how regulators gonna respond. And of course, all right, if you regulate all this, if you regulate and force them to go via an intermediary and have a bank and have somebody who's licensed to be overseeing the system and etc. Of course, over there you lose some of their efficiencies.
Okay, we have two questions on the question and answer, and one question on the chat. You can see both?
Yeah.
So it's your choice. The three questions are there. Two on the.
Yeah, I'll start from the one from the chat. The question is, can we say that the next financial crisis will come from losing your passport or from a technical issue in the system? Has the trigger of this technological crisis coming from the technology itself? Hence, what is the role of regulation is regulators don't have adequate technical knowledge. It's from Daniel de Alva. So yeah, I mean, that's a great question. And yeah, I mean, then the new crisis, if these things become really widespread, the new crisis will come from a bug in the technology. I mean, for anybody who is dealing with financial regulation, you all remember what happened with high-frequency trading, right, in the collapse in the US a couple of years ago. So where, right, there was some codes, some errors in codes. So and after this failure, I'm using the example of high-frequency traders in order to show the way forward for our field, for our today's talk. So think of what happened after after these issues with high-frequency trading is that the European Commission, for instance, published certain rules which are trying to seal trying to make high-frequency trading firms more resilient and try to protect the financial system against them. And basically, some of the rules are kind of like, all right, you should backtest your algorithms. You should make sure that your algorithm is working correctly. But the European Commission couldn't go and basically say what the algorithm should be like or what its technical details should be. So the approach that the regulator can take, it's pretty hands-off. I mean, you cannot really, a regulator cannot really go inside there and, I guess, not now, I guess, doesn't have the knowledge to go inside there and examine all these different algorithms. So exactly, there's the big fear that these algorithms, these codes, these software codes will not work properly.
Okay. The other two questions on the questionnaire, anonymous attendee. Can you see that question? Second question is, do you have any thoughts on ongoing policy debates, especially the US, where the Biden administration is looking at crypto, CBDCs, and potential regulation, including description of crypto as a matter of national security? Similar debates about whether to regulate or ban crypto in India and Russia. So, all right. So exactly, there's a big discussion going on right now, especially with respect to whether economies should basically introduce central bank digital currencies. Central Bank of England, the Bank of England is contemplating it. It's also created working groups on it. The European Central Bank recently came out and said that we're thinking the launch of a digital euro in the next 5 years. The Central Bank of the Federal Reserve has been thinking of it.
they're experimenting with, and of course they're experimenting very much with blockchain technology. So regulators are very interested in it. So, and the point here is why they see it as a national security. The big point here is basically China, especially for the US. China is very active. It's made blockchain technology a central tenet of its economic plan. So it wants to be first leading in blockchain technology in the world, and that's why it's also the more. It also has the most advanced plans for it's the most advanced jurisdiction as far as central bank digital currencies is concerned. So that's why, and that's one of the reasons why you see this interest in the US regarding digital currencies.
But I mean, what if the market players or the people in this virtual world, they do not need or they don't want the recognition from the sovereign states, then regulation doesn't make sense. The only way to regulate is to, close down the internet. So you can't, because so long as it is within the virtual world, they are trading, they are doing business. So they couldn't be traced, they couldn't be regulated. So regulation maybe it could be a price for recognition. Otherwise, if they don't want the recognition, the interface.
Yeah, exactly.
Work. So the regulation doesn't make sense. Am I right?
Yeah, exactly. In essence, it's a paradox.
Yeah. So yes, if you want to ban it, you can ban it, but you can't stop it because people could still trade it.
Exactly. You really can
down the internet.
Yeah, exactly. You really cannot stop it. And that's one of the problems in general of the internet. Is right. You cannot stop a lot of things that inside the internet, right?
You close down the internet.
Yeah, exactly.
Okay, there are more questions.
And one more question. Wait a second. I think. Wait. What do you think about the latest regulatory actions of China and India on cryptocurrencies and the relevant drop in the crypto market value? Do these prohibitions from cryptocurrencies directly relate to the future of fintech? So I guess the major reason why these jurisdictions are banning crypto is because of capital flight. So the point with crypto is in a lot of countries, and you see it, so that in countries where you had currency crises like Venezuela, for instance, or Turkey, or etc. So in a lot of these countries, when there's a currency crisis, the government basically either bans or sets limit on the amount of currency that you can take out of the country, or on the number of dollars that you can hold, right? Whenever there's a currency crisis, people basically rush to a safe haven. So, of course, safe havens are currencies such as the dollar, the euro, and it's any dollar-denominated asset. So, and because a lot of these governments basically ban these things, when they want to support their own currency and they're afraid that money will leave the country, basically people shift to cryptocurrencies. So they're basically used for that reason too in some countries. So, and that's why you see some of these countries moving in and banning these cryptocurrencies altogether. So I don't think that their major preoccupation is consumer protection over here. And and the final question, do you have any thoughts on NFTs, non-fungible tokens? Some claim that they are innovative financial tool with many potential uses, while others say they're a house of cards that are yet another risky investment. So, non-fungible tokens are, just to give an overview, are basically tokens that are issued in this decentralized platform, and they basically represent something, a unique asset. So, right, there are people that are issued, and basically they allow the creator of these assets to basically earn money. So you can basically sell a non-fungible token, which is representing a fine work of art, a painting, on a decentralized platform. So, I guess it depends on the way you see it. Of course, right? There are a lot of I mean, there are people who are like, oh, okay, I'll just write a poem today and go tomorrow and sell it on the market as a non-fungible token, and it happens all the time. Especially younger people do that. Of course, I cannot say that it's a scam, right? Because I mean, it's a marketplace. I mean, people buy and sell whatever they want, right? You can find. There may be some people that find your work of art very interesting, and they really want to buy your non-fungible token. I mean, it's individual buyers and sellers over there.
Yeah, I mean, the fungibility is because when the money on its origin is fungible, it has to be absolutely fungible. And when securities were created, were fungible, and they were not fungible at some points, but then dematerialized, and they lost, and they got closer to the money and whatever kind of the money. And then when you take it to the virtual world, in the virtual world also it is assumption among so many people. So if they give it a kind of fungibility, which is tradable without any qualification, then it serves the purpose of being a money. So fungible, more money-like.
Yeah.
So maybe in the ancient time, in the cave, people had the same idea of the cryptocurrencies now we have. But when it comes to the token, I think they are equal to securities because they are representing another asset, or they are. But when you want to make them special and non-fungible, that is what you can. Of course, it's an assumption, and you can give it a special number and make it non-fungible.
Yeah.
But then the issue is the platform and the people who within that platform, they accept it.
Exactly.
If they accept it, they accept it.
Exactly.
Stop people accepting this one.
Exactly.
Want to stop people using the cryptocurrencies because they accept it. So long as there is internet, there are cryptocurrencies, and there are. So that would be. I think you missed one question here. I don't know if you answered it or I thought you answered different kind of question. Yavuz Kaftar asked, hi, thank you for your presentation. What do you think about the latest regulatory action? I think you answered that one.
Yeah, I answered it about about China and India.
So anyway, is there any other question? This is exciting, and I think we are enjoying your talk, and then this particularly question. I would like to thanks those who actually raised question. I mean, we could take more questions if anyone else has any question. Otherwise, I mean, I enjoyed also talking to you when it comes to the NFT and then really fungibility and non-fungibility. It is not much into that the virtual world and the blockchain technology, which allows that kind of the assumption. I think maybe in a very, very ancient time, people in the cave, they had the same kind of assumptions that credits.
Yeah. Exactly.
Now, because technology allows this to happen at a very large scale compared to the ancient time, and they bypass the governments because the government is again another intermediary. I don't know if this goes further. There could be, but there should be somewhere the optimal level of interaction between the virtual world and then the sovereign world. There should be somewhere. I don't think we can totally rule out the forces of the sovereign states and then go to virtual. On the other hand, the governments could not ignore, or they allow some kind of, this virtual world. It is an autonomous virtual world, which is
exactly
in a way sometimes it's tolerated. In a way, they can't do anything about it.
Yeah,
like any other thing, they couldn't do in an actual economy. They couldn't really eradicate the drug trafficking. So. By all means, they could not do the same in the virtual world, where people, they trust each other. You can't stop them trust each other. And then, of course, the interface is the issue. So, anonymous attendee says, will this book be published as an article? This is for you to answer.
No, I just answered. So, I just sent the details. I touched upon some of these issues in an article I wrote with a colleague, which is called Governing Digital Finance in the EU. It's with Emilios Avgouleas, and it's published at the European Company and Financial Law Review. So it's a special issue. It's open access. You can go in there and or you can visit my SSRN page or go to the web. To the websites of the European Company and Financial Law Review. All right, and then as they mentioned to me, there's going to be this talk will be recorded, is recorded, and it's going to be basically broadcast.
Published on the YouTube or something.
Yeah,
my colleagues, they know it.
Given so-called rug pulls, where founders of projects withdraw funds, that's causing investors to lose their money. Impact on the spread, public acceptance of crypto and decentralized finance, will still remain skeptical to these tools. Any thoughts? Yeah, exactly. I mean, there are a lot of issues with and also a lot of issues with attacks in decentralized finance, right? A lot of funds lost, or as you said, this case of rug pulls. So yeah, I mean, I do think that all these applications should become more professional, right? Meaning that they should, and I guess it's still in an early stage. So I guess as the whole ecosystem matures, then we will have less and less of these kind of problems. However, an important thing to note is that these problems haven't caused, all these things, all these attacks and etc., haven't caused any serious problem on the financial system, right? There hasn't been any major, spillovers to the traditional financial system.
Okay, so it seems that you covered all questions. In my turn, and on behalf of everybody, I would like to thank you for great presentation.
Thank you very much for the interesting discussion.
Thought-provoking, and then still we are trying to figure out really what direction these developments will take. So anyway, if there is no question, please join me to thank Alexandros for his great talk, and then I think this is a time to close down and wrap up this session, which was a very useful session. Thank you to Dali for support.
Thank you also, Dali. Yeah,
technical support.
For coordinating everything.
Okay, so we would like to thank everybody, to thank Dali for the participants, and particularly Alexandros for the great talk.
Thank you very much, Mahmoud.
Goodbye to everybody.
Goodbye. Thanks for the attendance. Bye-bye.